Welcome to Behind the Ticker. I'm Brad Roth, Chief Investment Officer of Thor Financial Technologies and Portfolio Manager of THLV, the Thor Low Volatility ETF. Behind the Ticker uncovers the inner workings of the ETF industry. We will interview portfolio managers and ETF service providers to dive deep into their work lives and their businesses. We will learn the inner workings of their strategies and what drives them as they continue to grow their company. Many of these individuals are entrepreneurs and will have unique and compelling insights to share as much goes on behind the ticker. Please note, nothing in this show is investment advice, and it is meant solely for educational and entertainment purposes only. Welcome to Behind the Ticker. Today we have Neil Azous. He runs Rareview Capital. They have a model business which is goal-oriented rather than risk-oriented. And he also has a series or a suite of 4 ETFs. We're going to talk mainly today about their systematic equity ETF, ticker RSEE. That is a long-short strategy. And we dive into a little bit why long-short can be a great complement and benefit to a holistic model portfolio construction. We also talk about their dynamic fixed income ETF, ticker RDFI. Again, very unique construction, uses closed-end funds, and makes a very compelling case as to why this is a beneficial strategy. So without further ado, let's bring Neil Azous onto the show, and I hope you enjoy this conversation with him. Neil, welcome to the show.
Thank you for having me. Pleasure to be here.
So Neil is the founder of Rareview, and so I want to talk to him today about his firm and about his background. So why don't we just jump right into it? Why don't you tell me a little bit about Rareview and tell me about your background and how you got into the position you are today?
Sure, Brad. Rareview Capital is an independent SEC registered investment advisor and ETF sponsor. Above all else here, we champion goals-based investment management. We believe aligning investment solutions with investment goals is really the best approach to reaching one's aspirations. You know, the idea of investing by a style box or exposure to a region or an asset class, in our experience, does not deliver the real world outcomes that investors seek. And that's our overarching philosophy at Rareview, Brad. In terms of where we fit in, I believe the asset management industry can be grouped into 3 buckets. The first one is disrupting the existing distribution framework, or the electronification of investing. So think of robo-advisors. The second one is commoditization and scale, or passive management. So think of the large firms out there, Vanguard, BlackRock, Dimensional. And then the third one is specialization that requires expertise or active management. I would want you to think of Rareview Capital as fitting into that third bucket. That is, we specialize in non-traditional investment strategies. We deliver model portfolios to third-party asset management providers. We implement protective strategies that require derivative expertise. We focus on customized solutions, especially anything related to interest rates. And finally, we produce our own research. We don't consume it. Regarding my background, I'm the founder, the managing member, and the chief investment officer of Rareview Capital. I head our investment team and oversee all portfolio and risk management activities. And I also serve as the portfolio manager to the 4 Rareview ETFs that we manage. I've been fortunate enough to have worked at some great firms like Goldman Sachs, Donaldson, Lufkin & Jenrette, and UBS Investment Bank. And I've been trained in various capacities by some of the best minds in the industries that have pioneered various products that we use every day in the capital markets. And as a result, I have a multi-asset background, a global macro investing foundation. And I guess the best way to think about me is I'm not a bull or a bear. I'm neither an inflationist or a deflationist. And I absolutely have no religion when it comes to contentious topics like gold or China. They're just another commodity or country to me. Ultimately, I'm agnostic to the region or the asset class or whether something is a cash or derivative instrument. And the benefit to all that is that it allows me to be process-driven and reduce human emotion when it comes to investing.
Well, you and I then share a lot of similarities. That's how we definitely view things as well, agnostically, which is why traditional media for guys like you and me, Neil, don't work so well because they ask us what our opinion is on, the tech industry. And It sounds to me, before we jump in here, that when you have a process like that, you really don't care. And the signal is the signal. Am I assuming too much there, or is that kind of how you view things?
No, that's exactly where we skew towards, and we try to stay to that philosophy to the best of our ability.
Yeah. So before we jump in, I want to talk more about Rareview. I have some questions, and then obviously the ETFs. But I like to ask everybody on the show, what do you like to do outside the office when you're not working? Do you have any hobbies, things you enjoy doing, when in your spare time?
A few things. I like to play tennis. I like to go on walks, listen to podcasts. I'm an old movie buff, so I still watch movies, listen to music. But at this stage of my life, I spend most of my time on three things: my family, the health, and work. Not a lot to do outside of it. I wish there was more time.
That's great. Yeah, I would really like to get into playing tennis. I've started watching that Netflix series Point Break, and it looks fun, but I stuck to golf, and I didn't pick up the secondary country club sport, which would be tennis. So maybe something I'll do when I have some more time and not have young kids, because I have a family as well. So we're here to talk about two of your ETFs specifically, and also we have two more. But let's talk about the services of Rareview Capital as a whole. Can you explain to me kind of the ancillary services outside the ETF? So the model business, and kind of what you're delivering to financial advisors to deliver to their clients?
Yes. So we have two businesses here: asset management and wealth management. The asset management is anchored by our ETF suite. Wealth management is more traditional, although we're a bit more selective in how we work with people, as we're focused equally as much on the asset management side. Within that, we also offer an outsourced chief investment officer solution, which includes the delivery of model portfolios. And then separately from that, we may deliver our model portfolios to various Tamps or turnkey asset management providers. But what we're really trying to do in that entire role is either give access to our models, but at the same time help other financial advisors grow their business through efficiency on the investing side. And those services can range from anywhere from attending their regularly scheduled investment committee meetings, the delivery of model portfolios, helping them with marketing, consulting solutions of that like. We also do one of our main value adds is that prior to the launching of our registered investment advisor and our funds, I owned and managed a global macro research firm. And so part of our deliverables, which we make complementary to our investors or shareholders or prospects, is that we provide them our research. And our research focuses on three things: idea generation, risk mitigation, and portfolio construction, most importantly. And so we're trying to fill that void between economic strategy and trading, of putting it all together in a process-driven framework, and then being very transparent about that and filling in all the blanks regarding the questions around portfolio construction, what the market is doing, et cetera. And so we make that available as well.
Yeah. So let's talk about model portfolio construction. So you have, as you alluded to, and I was on the website, a goals-based approach. So you go down from growth, or you start from growth all the way down to kind of asset protection. How are you building those models? And are those models also active as your ETFs are, or are you letting your active ETFs do the work inside of those model frameworks?
So it's a combination. I'll come back to that second question in a minute about what's implemented inside them. But broadly speaking, you have two types of approaches to those model portfolios. One are the traditional risk-based ones where you're grouped in sort of an 80-20, 60-40, 50-50, type of blend between stocks and bonds. We don't subscribe to that where, it's specifically based on your risk tolerance. It's more so geared towards what goal are you trying to achieve? And when you dumb it down into really three or four buckets along what I call the wealth curve, you're left with, you want to grow your money, you want to preserve your money, or I guess outperform the loss of your purchasing power. And then in the third phase, you want to spend your money, or the income phase. And then in the fourth phase, you want to be able to transfer those assets to the next generation or some other entity. And so our portfolios are more geared towards achieving those goals. And while it's always important to consider asset allocation, style premia, all of those things that would traditionally go into that, it's less of a focus. We want to just meet that goal and find the best instruments to meet that goal. So that's the primary input to those portfolios. regarding the security selection, they can range from passive or active. They can be low fee, like a Vanguard. They can be a higher fee if they're trying to triangulate on to a particular outcome. And in terms of our case, we have one ETF or model that fits into each of those buckets. But they're not going to be 100% concentrated in that. They will be a measured amount. So we will certainly use other instruments in there that meet what we're trying to do in terms of that goal. But our product could be anywhere between 2 and 15% on average into those models.
Great. Yeah. And can we talk about how holistically across the firm, investment decisions get made? You had said you're agnostic and aren't really focused too much on or what China's doing or what gold's doing, right? I'm assuming you have a very strict rules-based and systematic process. Can you explain that? And am I on the right path there?
Sure. So it's different for each asset class or potential product. So on the fixed income side, for example, our discipline is probability-based outcomes using the vast array of instruments in the fixed income markets, either the short-term instruments or the long-term ones. There are so many instruments, and it's the only asset class that you can pick a scenario in your head and then go recreate that using those instruments, looking for a particular outcome. So we focus a lot on the shape of the yield curve. We focus on probabilities around the path of Federal Reserve policy, and that's a model-driven approach. So we have a spreadsheet. We have lots of different inputs in there. It's been refined or honed over decades, and it helps us identify where the asymmetry is in various probabilistic outcomes. So keeping things simple, on a scale of 0 to 100, something gets between 80 and 90, we want to sell it. Something gets between 0 and 10, and we want to buy it. And then rinse and repeat that as the probabilities around the path of the interest rate hiking cycle or a cutting cycle start to change every 6 to 8 weeks. So it's completely model driven on the fixed income side around that. Secondly, on the income side, we're specialists in closed end funds. And so that's a model that's built in Python. It identifies to us the least expensive or the cheapest security on an intra-sector basis. So if we've got 10 or 11 sectors across fixed income, we will identify in our model what we think is fundamentally the cheapest one. And then we will implement that. And as it changes in its valuation through this model, we will sell that out and buy another. On the equity side, we've partnered with a firm called GST Management that is, in my opinion, a world-class index methodology developer of strategies. And that product is algorithmic, it's systematic, it's quantitative. There is absolutely no human emotion or discretionary override involved in it. The idea of it being long short is that it's risk mitigating by itself. I mean, it's developed that way. And so there really doesn't need to be a human to decide what it needs to do in terms of going long or short. So everything we do here in sort of that decision-making process is model driven. There are different types of models, but that's the primary input for us. And then secondarily, we want to do everything as quantitatively as possible. And the idea being here is that it's like Moneyball baseball. It's statistical. We want to play in favor of the statistics that are higher degrees of success and stay away from the ones that are human-driven or that force you to be in your seat at any given time, knowing that you're never in your seat when it matters the most.
No, it's interesting and very similar to how we conduct some things over here. But kind of the last question before we pivot, since you have both sides of the business, model delivery, as well as the ETF and the fund business, which side do you feel or find to be more challenging, specifically kind of around growth or even just day-to-day maintenance?
I appreciate that question a lot, Brad, actually more than you know. It's something that hasn't been asked to me in a long time. But as a business owner, but also as a CIO/portfolio manager, you think about things differently, and it's sometimes challenging to separate that, meaning you might have passion around investing and really believe in your product. And then on the flip side, as a business owner, you have to weigh the resources that go into certain deliverables and what your ROI is on that. In my experience, the ROI in the Tamp business, as much as I appreciate the growth of that channel, which is fairly substantial these days, is really horrific. The idea that somebody wants to work for 10 basis points to 30 basis points, potentially cannibalize the rest of their businesses in terms of ETFs or wealth management, either one. And then the time spent on that from a regulatory or compliance standpoint. And then in the sense of you need to make sure that you're treating all of your investor bases equally along the way, meaning a wealth management client is treated the same as a Tamp deliverable on a model, as well as your ETF, and how you do that. In my experience is that it's an important piece of the puzzle to be involved in the Tamp world and the model delivery. And it can mirror a lot of the models that you currently run. But by the time you introduce the business component in terms of JIP's performance tracking, marketing to the various Tamps, managing those models equally as if you're running them for a wealth management client or an ETF, so you can see the P&L in real time like it's yours, is a very big challenge for me personally and for our firm. And I would be remiss to say that it hasn't been less than fruitful in my experience. And so it's not one of these exercises any longer like it was maybe 5 or 6 years ago. You go put a model on a platform and you think somebody's going to buy it, which they used to a lot. Now, you don't just do that. You have to pay to get onto a platform, and then you have to have a body that's dedicated to that platform to market to it. And these marketplace or these platforms that have marketplaces that allow this, they now have 1,000+ type of investment strategies on there. So the competition in that open architecture is extremely high, but you're generating probably 1/3 to 1/4 of what you normally would in some other type of revenue stream. So it's really a question of your resources, but economically, it's challenging from the business standpoint.
Yeah, I couldn't agree more. The one thing I think you left out there is the expectation of the advisor who's using that model of you as a manager. I feel is when someone goes out and buys an ETF, they have a place in the portfolio for it and sits there. And if it does well, great. If it doesn't meet their expectations, right, they sell it. When you're driving kind of core model business for advisors, sometimes the expectation not only for that model to perform, but also the expectation of the advisor for you to provide ongoing support for that model, whether it be commentary or webinars or talking to prospects or clients of theirs, can also be a heavy lift.
That's a good point, Brad. I agree with that a lot. It's good that you mentioned that extra part. That's one of the reasons we provide our OCIO service or consulting. It's a much higher touch deliverable than, hey, go buy a model, read some research that comes out once every 2 months, and expect that to be a winning relationship long term. Yeah.
So let's pivot. I want to talk about your systematic equity ETF, which is RSEE is the ticker. You're the first long short ETF manager we've had on the show. We've had a lot of really unique and boutique strategies on here, but you're the first that runs a long short equity strategy. This is really kind of a two-part question. First is, why is long short an important component in an overall model portfolio? And second, how do you go about setting expectations for advisors going in? Because as you and I both know, market volatility where long short is very helpful, kind of clusters around best and worst market days. And sometimes you have to be on the wrong side of a short trade for a little while until it materializes. And sometimes that's hard for them to understand. So the question really is, why is it important for them to have, and how do you go about educating the advisor as they implement it?
Sure. So to answer your first question, the historical component of adding a long short hedge fund, or really any hedge fund, to a portfolio was to generate some additional performance, or quote unquote alpha. That really was the pathway from, say, 1995 to 2008. Since the global financial crisis, the hedge fund vehicle has become more of a diversifier as opposed to an alpha generator. And so what you end up with in today's world with the 10,000 plus hedge funds out there in that strategy is more of a risk mitigator, something that helps manage the downside risk. But in order to do that, you've given up a super majority of the upside potential in terms of performance. And so it's a trade-off. You want to mitigate the downside, but you got to give up the upside. That's the traditional approach and where we've really been for the last 15 years. I don't subscribe to that philosophy. In my experience, Brad, clients or investors are accustomed to weathering a garden variety stock market correction of, say, 7 to 15% once every year or once every 2 years. And if the markets are down, they don't have that big of an issue with their financial advisor or ETF manager. However, if the stock market's up 20% and you're only up 4% because you're running, quote unquote, some type of hedged product, I tend to see people fire their financial advisors or replace that ETF with another one due to that significant underperformance. So what I'm saying in English is that upside capture to us is very important, if not equally as important as the downside capture. And that's really the trick. And finding a vehicle to solve for that is not easy in the traditional long-short space, because by default, they run somewhere between, depending on how conservative they are, a 20% net long to, on average, a 60% net long. So let's just call it 40% net long, or 0.4 beta to the S&P 500. So by default, if the S&P is going to be up 10%, they should be up around 4%. They're leaving a lot on the downside. Leaving a lot on the upside, based on that model. In our particular case, we wanted to reimagine that. And we sat out and said to ourselves, what do we need to create, or what is the product? And so I came across a person. His name is Rod Jones. He runs a firm called GST Management. He worked at some of the top places in the world. He was an index methodology expert, consulted and constructed portfolios for some of the largest pools of capital in the world. And we discussed this product, which is now the strategy that drives the Rareview Systematic Equity ETF. And what we wanted to do was find a vehicle that addresses what I think is the seminal investment issue for investors, which is, how do you stay invested in bull markets, avoid the catastrophic stock market sell-off and bear markets, and then minimize that time back to break even. Now, I know every product looks for that, but in our case, we made an acknowledgement, or Rod's strategy acknowledges that in order to try to achieve that, meaning you're going to participate on the upside, you're going to avoid a catastrophic drawdown that is very difficult to recover from. Catastrophic defined as something south of minus 25%, not the garden variety stuff that happens every 1 to 2 years. And then figure out a way to stay invested, minimize your time back to break even. There has to be something of a sacrifice in there. And the sacrifice is that you don't know what's going to happen tomorrow if you're long, and you don't know how much you have to give up on the downside, meaning you have to sacrifice potentially the first 0 to 10% on the downside to achieve this type of goal of staying invested during bull markets for the long period of time. And that's really what we're talking about here. And then at the same time, you want to remove the human emotion. And so what the strategy does that drives the Rareview Systematic ETF, or RSEE is the symbol, RSEE, is that it makes a difficult decision when to get back into the market, as opposed to the human financial advisor trying to pick the absolute bottom or make that determination overall. And it won't always be perfect. You're never going to pick a bottom. But what it will do is make that decision to get long. And then when it gets long over a period of time, it will average in, or it will get longer in that episodic period. And you will be back in the game of staying invested and help you get back to break even quicker. And so that was where this strategy fits in. And in our case, just to take a step back, we have a the strategy has a philosophy where we don't believe that markets are micro efficient, but we believe that they're macro efficient. So that's the old dictum from Nobel laureate Paul Samuelson. But we focus, or the strategy focuses on index level exposure to add value. We find that it's possible to generate above active equity returns when you exploit the behavioral patterns on a regional basis or in different volatility regime. We don't believe that that's the case in picking single stocks, meaning the alpha generation is extremely hard and isolated to just a small group of the 10,000 funds that do that. And then secondly, we also find it very difficult from quote unquote a risk adjusted return basis to try to focus on style premia or picking sectors. For example, being long tech versus short energy, you might be having a very good year this year, but last year you had a terrible year. And the volatility of that approach is probably 2 times the amount of the stock market for being compensated half those returns over the long. And so we just stay away from that. Our goal in launching this product and partnering with GST management on this strategy was to fill the void of finding a solution that can stay invested, get short when it needs to get short, keep it simple to index beta, and keep people in the market, as opposed to we want to focus on factors or style premium or single stock selection. We're trying to address a long-term solution, a core solution for our investors. And that's really the trick here. And so that's how we approach it. I can talk in length about certain things about it, but in general, our goal is to capture the upside, not just the downside, meaning we seek to beat the market in bull and bear markets, not just one.
Yeah. So it leads me, I think I have the majority of this, but in terms of security selection process, you mentioned an index-based approach. So are you continually trading a fixed set of holdings, or we'll call it like a bench, or are you kind of rotating throughout different indices?
Sure.
How are you building the holdings of the portfolio?
Yeah, it's very simple. So the investment objective is to seek a return that exceeds global, developed, and emerging market equity. And so the fund's benchmark would be an all-country world index, and the performance or the strategy's performance is derived from 4 regional sub-strategies that we believe target important sources of global equity market return. So there are 4 indices: one that tracks U.S. large cap, so the S&P 500; one that tracks U.S. small cap, the Russell 2000; a third one for non-U.S. developed markets, such as EFA, and then the final one being MSCI Emerging Markets. And so there's always 4 indices. They never change. The weightings of those 4 indices mirror the weightings of all country world index, meaning the global benchmark for equities. And that's it. And at any given point, those 4 sub-strategies could be long or short.
Okay. Now, when you talk about, so you hit on weighting, but that weighting is going to be variable because of the active nature of the strategy. And you alluded to this somewhat when you were talking about the strategy, where it could kind of lean into the market and average in. So is there a position sizing variable, like certain states that the algorithm might be in to say, hey, we want to be fully long, we want to be a little bit more neutral, and we want to be short, we want to be really short? Like, how are those active weighting decisions made in real time on those 4 indices?
Nah, they're fixed weightings.
Okay.
And so keeping things simple, like U.S. large cap is always going to be around, say, 42% of the strategy. That doesn't change, it rebalances monthly, et cetera. But there's no, I like this, or I want to overweight or underweight that. Those weightings are fixed. The strategy overall can either be 133% long or 33% short with 67% in cash. And so you can think of it as if all 4 were long, we'll be levered or $1.33 for every dollar that we have. If we're short all 4, there will be 33% of a net short exposure and 67 cents in cash per dollar at that time. And those 4 strategies have different permeations depending on whether they're long or short at any given time. So currently, for example, the models that drive each of those strategies have long-term buy signals in them. And so we're long all four of those sub-strategies. And the total exposure of that is 133% long. And that's broken down in terms of the all country world index, weightings.
Got it. That makes a ton of sense. And are you getting the leverage by using futures? Is that how you're adding portfolio leverage?
You can acquire it several ways. We're very focused on what I call operational alpha at Rareview Capital. And what I mean by that is we are highly sensitive to costs and taxes or tax efficiencies. And so when you use futures to toggle long and short, so for example, we'll always have a long base of 4 ETFs that make up 70 to 80% of the weightings. To toggle long and short, we will use the equivalent of those futures, which are the most liquid in the world, those 4 in the equity futures markets. We'll do that for transactional cost purposes to keep them low. We'll do that to minimize the overall portfolio turnover. And then 3, the first 40% of futures of a futures position are always treated like long-term capital gains, no matter how long you hold it for, 1 day or 2 years. And so we want the added benefit of that. So it makes the implementation more efficient overall, and that's why we do that.
Yeah, that makes a ton of sense. And so when you're talking to an advisor, you're outselling this ETF specifically, how are you kind of driving them to make an investment allocation decision in their existing model portfolio suite? So is this something you're suggesting, 5 to 10% or 5 to 15% of the whole model portfolio?
Sure. So I guess I'd start to answer that question with stating that we view it as it can go into 2 buckets. First, it's a core solution, not a satellite position, and it belongs in the growth bucket. So if you were long the S&P 500 or held some type of globally diversified equity portfolio, we're a replacement for that, given that the product is globally diversified at the index level. So we view it first as a core solution. To decide what weighting that should be, what we would normally do is take a snapshot of somebody's existing portfolio, if they're willing to share that with us, and then provide them a replacement analysis in different weightings between 5 and 60% to show them what the increase would look like the benefits would look like in terms of risk-adjusted return profile. And so, meaning, is the optimal performance at 20% of a weighting or 10? And we'll demonstrate that in a spreadsheet so they can see what that looks like and then decide for themselves what the right weighting is. If you want to just keep it super simple and somebody had a traditional 60-40 portfolio, 60% stocks, 40% bonds, we would advocate that we should be between 15 and 20% of that 60% on the equity side. And that would increase the risk adjustment.
Got it. So let's pivot to another product of yours I find interesting, which is the ticker RDFI, which is your dynamic fixed income ETF. Can you talk about the strategy of this product and what it's trying to accomplish?
Sure. So for those who are not familiar with closed-end funds, they're one of the 4 registered investment companies of the 1940 Act, along with open-end funds, unit investment trusts, and exchange-traded funds. And closed-end funds actually have been around since the 1890s. They've been around really for over 130 years. And there's about 530 of them that trade on the New York Stock Exchange. And if they're utilized appropriately, they can be wonderful instruments. If they're utilized inappropriately, they can be pretty challenging when performance is impacted from market volatility. So just a caveat up front is that if you're looking at closed-end funds, I would recommend that you speak to a specialist in that to make sure you're going about that process appropriately. The benefit of them is that, in my experience, they're the only instrument that I've ever come across where you can make money potentially 3 different ways. The first one is that they're an income strategy and they have a very high distribution yield. So, for example, the universe right now, depending on how it's asset allocated, you could be anywhere between 8 and 10% distribution. The second component to be able to make money is that there's potential principal appreciation from the underlying holdings, hence the or a la the NAV of that fund. And then the third one, which is the very interesting as well, is the potential for alpha generation, which is the what we call discount to net asset value capture. And so if the closed-end fund is trading at a discount to its net asset value, and you can buy that at, say, a minus 10% discount, and then over the next year, that discount narrows to minus 3%, you could lock in that 7% of discount narrowing or alpha. And when you combine that, you've got this high distribution yield that's going to pay you no matter what, unless they cut their dividend. And then you've got the principal appreciation potential. And if you have a model and you know what you're doing in terms of valuation, you have the potential for benefiting from this discount to net asset value capture and rinsing and repeating it. And so for us, we just philosophically love that profile where you have the potential to make money from 3 different avenues. And if you're not doing anything, if the markets aren't cooperating or you're not doing great on the discount capture process, at a minimum, you're going to get this high distribution yield, which helps generate the income or provide an allowance for somebody or mitigate potential market volatility. And so that's the background on that. In the case of the Rareview Dynamic Fixed Income ETF, or the symbol RDFI, what we've done is take in the non-traditional advantages of the closed-end funds, which are the ones that the 3 return streams that I just referenced, and married that with the traditional benefits of a dynamic fixed income strategy, which is a comprehensive fixed income strategy where asset class exposure is managed more dynamically or active, and it's really driven by market opportunities and risks, so not necessarily asset allocation. So in our universe, there are 11 fixed income asset classes. We would identify the appropriate weightings to each asset class based on the market opportunity and the risk in each of those asset class. And then once we've done that and determined the weightings, we have a model that would select the closed-end funds in each of those sectors and then optimize the weightings based on a number of factors to go into that particular sector. And what we found is that blended approach of traditional benefits and of dynamic fixed income and the non-traditional advantages of closed-end funds ends up being, a vehicle that gives you the allowance that you need if you need income or you have a budget to spend, but at the same time act as a potential total return product as well, and work in various environments over the market cycle when rates are more contained or come down.
It's extremely interesting. You answered a lot of my questions on it, so thank you for that. The only additional question I would have is, would this is almost, it's pseudo fixed income. I mean, it is a fixed income, but it also has the alpha generation. Where are you putting this in a model portfolio? Kind of the same question we had with RSEE. Are you going to be peeling from fixed income bucket in this case?
Yeah, if we go back to the wealth curve that I referenced at the beginning of this conversation, growth, preservation of capital, income, transfer of assets, this would fall squarely in the income bucket.
And is this kicking out a monthly yield as well?
That's correct. It does.
Yeah, that's great. So quickly, you have 2 other funds, 2 other ETFs. I might have to get you back on to go through them in more detail, but why don't you take the time to quickly touch on those, what they are, and what they're trying to accomplish as well?
Sure. In that same spirit of the income strategy, we also have one that uses closed-end funds but focuses specifically on the municipal bond closed-end fund sector, and that's designed for qualified accounts or strategies. People who are looking for that tax efficiency. So it's virtually the same strategy, but just at one particular sector level for people who are looking for tax efficiency. So those would be in our income strategy. The last one is our what's called the Rareview Inflation Deflation ETF. And the objective of that is to seek a rate of return that exceeds the rate of inflation over a business cycle. So what we're really trying to do in that is say, okay, the markets move from inflation to hyperinflation to deflation to disinflation. What is the proper set of instruments along those different regimes? Or you could look at it like, okay, we are entering a hiking cycle, then we're in a hiking cycle, and then the hiking cycle is over, and then we migrate to a cutting cycle. What are the best representations for each of those regimes? And they're different, meaning you could be long fixed income beta or short fixed income beta in any of those regimes. You could take a bet on the shape of the yield curve. Not to get too wonky here, but is the yield curve flattening or steepening? Those are very big decisions. And then the third one is, do you want to make bets in the options market? Define bets. You're never naked short volatility or short options, but define bets or long only bets on the path of interest rate policy by the Federal Reserve and make different bets on probabilistic outcomes using options. So in theory, there's three return streams, right? You get the market beta and the regime right. You get the shape of the yield curve right. And then thirdly, you want to get the path of the Federal Reserve policy right. And in each of those three return streams will make up some type of risk budget. And theoretically, they're all supposed to act as diversifying sources of return streams, doing something different. And if you can get all three right, well, you're going to have a really good year. If you get 2 out of 3 right, you'll have a good year that likely outperforms the aggregate bond index. And if you get all 3 wrong, well, then you're probably going to underperform the aggregate index. And so what it's really designed for is that if you've got a 60-40 portfolio and on that 40% or the risk-free portion of that 40% that sits passive, you hand it to an active manager like us, and we're seeking to beat that rate of inflation or the loss of that purchasing power over that market cycle to try to do better than what you would get just in that passive approach of not really doing anything with your fixed income beta or the duration in your portfolio.
Got it. Very interesting, Neil. I love the thoughtfulness of the product lineup. I think you have some really unique and interesting funds that can provide some additional diversification, some different ideas in an overall model portfolio for advisors. So first and foremost, thank you for your time. And where can people learn more about Rareview as well as your funds?
Thank you very much for having me, and appreciate that. The simplest place is always to start with the website at www.rareviewcapital.com. It's all in one place. The second one, I always encourage people, go to the SEC's website, read our Form ADV, do a deep dive on us, do your homework. But those would be the two main places, the SEC's website on our background, as well as our storefront being our website.
Great. Well, Neil, again, thanks for taking some time with us, and I wish you the best going forward.
My pleasure. Thanks again for having me. Enjoy your summer.